So, good afternoon once again. Now we've got everybody, I think, in there, and my trusty colleague Rick hopefully will be able to let some stragglers in. As I said, we are going to be talking and giving you a sneak peek of our latest white paper, which is all about AI and the agentic future of banking. Now, 2 years ago, almost to the day, 27th of June 2024, we actually published a white paper on AI and the generative AI in Benelux banking. As I said, June 24. And you may remember, if you cast your mind back 2 years ago, that back then Gen AI was this fantastic technology that everybody, it was trending, everybody was talking about it. It was the biggest news, biggest thing since sliced bread, and it was a powerful, technology that not many people knew how to use back then. And a lot of our research was about potential and possibility. And if you downloaded our white paper from back then, you may recall also that it was mainly people were viewing Gen AI as a bit of an intern, draft an email, summarize a document, surface an insight. But basically, you gave instructions, you received something back, and then you still had to do something. And in the space of the intervening 2 years, there has been an incredible change. And if you've been following or if you've been involved in any of the latest developments in AI, I think that you'll agree that this is potentially what I would deem a once in a generation change or a once in a lifetime change. And I've worked in innovation all my life, and this, I think, is the biggest change ever that we're standing on the brink of. So what I'm going to explore in this session is the mechanics, the opportunities, the risks, and the competitive consequences of the agentic future in banking. So I'm hoping that I'm going to be able to give you a bit of food for thought while you're eating your lunch. Now, the biggest change since 2024 has been the move from assistant to autonomous agentic AI. So 2 years ago, the prevailing sentiment across our community in the interviews was very clear, and it was unanimous. Artificial intelligence had now come of age. It was very much an assistive tool, and it opened up lots of possibilities, but it was passive. Humans had to prompt. It's probably the way that most of you interact with AI and LLMs today: Copilot, ChatGPT, Google Gemini, etc. Now, the difference with agentic systems is that they do not simply generate content, but they independently execute complex, multi-step actions, frequently across interconnected enterprise platforms. And they don't wait for a human to give them the input for the next step. They're goal orientated. So there was a lot of debate and discussion over various think tanks, roundtables that we held, and in our events as what constitutes a agentic system. What's the difference? What's the traits of an agentic system? And there was, one person in a roundtable actually made the comment of, does it make any difference so long as we get the budget? Now, that was maybe a bit of a frivolous comment, but there wasn't a clear single definition, and at the end of the day, a single definition doesn't really matter. And the key thing is that they can perceive their environment, reason about it, act upon it, learn from their outcomes continuously at scale and at a pace that no human could ever match. Now, there was one particular definition or framework that came out from Peter van Hees from KBC. For those of you that may have attended our event in Amsterdam this year, he delivered a keynote on his book, AI Agents, They Act, You Orchestrate. And in there, he shared a framework that he calls the APM test. And this is one that sort of there is broad consensus around across the industry. And the APM test is that agents must show autonomy, proactivity, and memory. So if a tool requires constant human prompting, or it lacks a memory layer to retain the context, it remains an assistant. It's not an agent. And that distinction is the difference between something that helps you do your job and something that starts doing a significant proportion of your job. Thomas Geering, in an interview last week with Rick, had said having a fully agentic system would mean you have an orchestrating agent that decides based on all the inputs and interactions with the outside world what to do next. Now, this isn't a future state. He was talking about what ING has already built for their mortgage processing in the Netherlands. And I'll come on to a little bit more of the specifics of that shortly, because it is very interesting what they've been doing. Now, before we get to that, I want to talk a little bit about scale, about why you should be paying attention to this, because the scale is not just compelling, it's actually quite staggering. Now, when I talk about scale, I have to, of course, quote some big consultancies. So it depends on how much faith you've got on the consultancies, but a couple of them have made some big predictions. For example, BCG and OpenAI, in a report, they estimate that agentic AI has the potential to increase retail banks' profitability by 30%, reduce costs by 30 to 40%, all by 2030. Accenture weighs in one of their reports, and they figure that scaled adoption of agentic AI across the top 200 global banks could increase their revenues by 5%, reduce operating costs by 8%, and cut loan loss provisions by 16%, which they estimate represents a potential $289 billion financial benefit for the industry globally. So when we're talking numbers of that magnitude, this isn't a technology conversation. This is a strategic boardroom conversation. But I am going to get a little bit nerdy now with getting into some of the nuts and bolts about how agents actually work, the agentic banking stack. Now, before I can talk to you about what the agentic AI can do, I just want to reiterate and clarify some of my understanding about what agentic AI is, because as I said, it is a little bit fluffy. So I just wanted to draw a couple of distinctions. So Co-pilots are the assistive tools most of you will be using with. They draft emails, summarize documents, surface insights. It is a bit crazy at the moment where people get AI to write articles that they send to other people or publish as blog posts, and other people get AI to then summarize that and just give them a short version of it. So you wonder, what are we actually doing here apart from burning a lot of AI credits? But anyway, co-pilots are passive and reactive. They require a human to initiate and complete every task. Then you've got traditional automation tools that are rule-based, deterministic, reliable, but they handle what they were programmed to handle and nothing else. When they encounter the unexpected, then they stop. Now, agentic AI is the proactive execution layer. It receives a high-level objective, decomposes it into subtasks, selects the appropriate tools, and then executes actions across your core systems, verifies its output against business rules, and only escalate when it reaches the boundaries of its decision-making authority. And then it learns from every interaction in order to improve its future performance. Now, before my screen went black while I was presenting, I don't know whether we have Wesley Woods on here. He is the senior customer advisor from SaaS, but I actually quoted him in our research because he frames one of Agentic AI's core value propositions as closing what he describes as the decision execution gap. And that's that big chasm between analytical insight, which we've been getting from these co-pilots and LLMs and ChatGPT and that, and then operational follow-through. Banks have been brilliant at generating insight and using AIs, and most humans are getting really good at doing it now at the moment. But agentic AI is what finally connects all of those insights into action automatically and at scale. So when we get into the agentic banking stack, we identified 4 classes of agents that financial institutions are deploying today. So first, we've got task agents. They handle bounded specific objectives like formatting data or triggering compliance alerts, extracting information from identity documents. They're goal orientated, but it's a small task. Then we've got workflow agents or automators, and they might manage broader cross-departmental operations like connecting fragmented processes into a coherent policy-aligned workflow. And mortgage processing with ING's real-world implementation of this is a fantastic example. I will still get onto that in a little bit more detail. And then we've got multi-agent teams that are systems of specialized sub-agents that work collaboratively with each other and with human colleagues in real time. So think of them as like a digital working group. Each member of them is an expert in their domain, constantly communicating to achieving a shared objective. Now, interestingly, we had a discussion about this at one of our think tanks where we were debating with a couple of people around the table the pros and cons of multi-agent teams, otherwise better known as swarms, or specific one huge big monolithic agentic processor that runs over end to end. And we'll go into that a little bit more in the white paper. And if it's something that you're doing, there's pros and cons of both approaches. The biggest benefit of the multi-agent teams or the swarms is that you can tweak just one part of the agentic process without having to dig into your entire single monolithic structure. And also, if the monolith breaks, the whole thing breaks, whereas in an agentic swarm, if one particular part throws up an exception, you immediately know where it's broken and you can go and fix it or look into it. And then finally, we have orchestrators. So supervisory orchestrator agents, they are the conductors across the entire network of AI agents and potentially humans, because orchestrator agents could actually give instructions to humans to actually do something in the whole workflow process. So they coordinate complex tasks and they adapt dynamically as the conditions change. Anshuman Chowdhury from Cognizant had actually stated in a recent interview that he believes banks require a blend of generic orchestrators for standard workflows and highly specialized agents for the nuanced domains. So he's saying combine deterministic orchestration with agentic flexibility to ensure safe execution. Now, slightly more nerdy, because underpinning all of this is what we have determined is called the agent control plane. This is the governance infrastructure that makes these agentic operations safe. And this is critical because an agent without a control plane is not a digital employee, it's a liability. So the agent control plane consists of 4 essential elements. First up, we've got identity and permissions. Every agent must be assigned a unique identifier, just as a human employee would be. So it allows the banks to be able to attribute specific actions to a specific digital entity, specific actions and permissions. So you need a vetted tool registry to go along with that. So agents must only interact with approved systems, and they must have limits. Again, just how you would have with an employee. We need deterministic audit trails. And this is really important because explainability is a I'll get my word there. Explainability is a regulatory imperative. It's not just a technical nicety. And on that point, Wesley also made a point that I want to highlight because it's one that the entire industry needs to really take note of. You can't simply ask a generative model to explain its own reasoning. That is fundamentally flawed. It's asking the system to mark its own homework. That's why you need deterministic logic wrapped around the agent so that the entire decision sequence can be independently evidenced and audited by your compliance team. That's not really optional. That under frameworks like the EU AI Act and GDPR, it is a legal requirement. And then finally, in the agent control plane, we need kill switches, mechanisms to instantly halt autonomous operations before an agent deviates from its expected behavior. And I'll touch a little bit more on kill switches later if I've got the time, just with a small anecdote. But let's stop being nerdy now and rather get onto the next wave of use cases. So where are banks finding agentic AI to be the most useful and actually genuinely creating value. So it's agentic AI is operational. You may not find examples that are fully customer facing. Sorry, I've just noticed that somebody had put something in the chat, I think, but I can't actually see my chat window. So apology for that. I just saw a chat icon pop up over here. I want to run you quickly through 6 high impact areas that came up in our research from the interviews and from what we're discussing. So the first one is perpetual know your customer, or living customer due diligence. Traditionally KYC has been manually intensive. It's been a point in time exercise. Compliance teams spend an enormous amount of time gathering documentation, and then it gets out of date very quickly. Now, this is part of what Thomas Gehring was describing in his interview about what ING have been doing and how it has transformed their operations, and their continuous KYC has become an event-driven process, a coordinated ecosystem of models handling data, behavioral analysis, risk assessment, and case summarization in real time. So first up, he was talking about the onboarding cycle, which one took days, is now being compressed to minutes. And something else that he had brought up was the need to do periodic KYC in the past, which causes a huge amount of work in a short space of time that you've got to balance. Do you hire a whole lot of people and bring them in just to be able to refresh your KYC and do the due diligence? Or do you load your existing employees with that and you do it as a big now it can rather be done continuously, perpetually, and the compliance around that is automatically ready for regulatory review. The second one is continuous controls monitoring. So traditional internal audit operates again on a periodic cycle, and by definition, it's always backward looking. Whereas agentic AI enables real-time surveillance across your entire estate, flagging anomalies before they become incidents, and proposing or even carrying out specific remediation steps, and maintaining that boundary where human sign-off is required for exceptions. So compliance now moves from a reactive, retrospective exercise to a proactive, preventative management capability. Now, a big one is around fraud and financial crime. And in our Q1 white paper, AI specifically has been applied to fraud and financial crime in a very large way. Banks have been seeing massive benefits in applying just even Gen AI to fraud and financial crime. But now with agentic AI, it's even bigger benefits they can get. And potentially it's even where the competitive stakes are the highest and where the threat is the most acute. Jonathan Neuburg, Chief Digital and AI Officer at Belfius, was on a panel, and he shared a fairly sobering observation in Brussels recently at our event, saying the malicious applications of AI currently being observed are frightening, making the element of trust and brand reputation more critical than ever. If you are being attacked by AI, and banks are, there's a lot of institutions that are being attacked by malicious actors using AI. This is unlike anything banking has seen before. Bad actors are deploying AI to bypass traditional security measures. Therefore, the banking response must evolve from just detection to actually adversarial containment and combat. Rachel Hadaway, VP of Product Management at FICO, identified near-term opportunity as intelligent case buildings, where agents synthesize evidence from billions of data points to intercept suspicious patterns in real time. And there's some quotes in the white paper where advanced AI programs are now capable of screening over 1.2 billion transactions per month, detecting between 2 and 4 times more suspicious activity, while simultaneously cutting false alerts by approximately 60%. And we've also got another stat in there where integrating AI into cybersecurity detection and response can reduce the mean time to detect and recover by roughly 28%, which is generating savings of around £1.4 million per initiative. Again, references are all in the white paper. For those of you involved in the fraud space, you may, over the last week or two, have picked up on Revolut's announcement about their Pragma foundational model. They've done a case study, published a case study with the NVIDIA, and on Revolut's internal benchmarks, Pragma delivers a 64.7% improvement in fraud recall and a 16.7% lift in fraud precision over their prior production model that they were using. So again, if you're into the statistics and if you're into the technical side of it, have a look. Just Google Revolut Pragma NVIDIA study. It's, again, really nerdy reading. Sorry, I am a bit of a nerd, and I found it absolutely fascinating what they've been doing with their model. The next one up is where ING's story becomes particularly instructive. Mortgage and loan processing. According to Thomas, they have built an almost entirely agentic backend for mortgage applications in the Netherlands. So they're autonomously handling document processing, collateral checks, risk profiling, and file preparation. So human advisors still remain in the loop for the final decision, and particularly for the emotional development, the emotional dimension for what most customers is potentially the most significant financial commitment of their lives. But the administrative heavy lifting is all done by machines. For those of you that might have read the recent paper published by FinTech Belgium and Cellpeak, in their research, they quote stats from a Belgian fintech called Opper Credits that have deployed an AI agent that automates approximately 90% of manual review work in loan applications, and they say that they cut the net handling time from between 10 and 15 hours down to just 3 minutes per application. And they claim they maintain a 98% accuracy target. And they retain the human in the loop just for low confidence data points. 3 minutes per application, 98% accuracy. That's not just a incremental improvement. That is an absolute structural transformation. That. The next one up, credit underwriting. Again, as an adaptive system, innovation lead at one of the Dutch banks shared that they have experimented with agentic AI to write credit memos. And they had discovered that while the underlying data is well structured, that when the underlying data is well structured, the AI produces advice that is often superior and more accurate than that of human analysts. I found that incredible. And another stat from our white paper, using AI to analyze alternative data sources such as open banking transaction histories or utility payment patterns, has been shown to raise credit approval rates for individuals without traditional credit records from 16% to between 31 and 48%. That's a fundamental expansion of financial inclusion. And then the final one that made the shortlist was hyper-personalization. And this was a fairly big chunk of a discussion and a key insight that came out of one of our think tanks. Banks have relied on broad segmentation for decades. One of our roundtable participants said, yeah, traditional segmentation is riddled with biased assumption and treats every private banking client as a 60-year-old male with a luxury saloon. Again, it was an off-the-cuff quip, but it's sort of indicative with the way that segmentation has been applied so far. And agentic AI makes it possible for the first time to literally serve individuals across all of their roles and complexities without friction and at scale. And the impact, the financial impact of getting this right is measurable. More step from the white paper, where deploying the next best action models to proactively anticipate customer needs has been shown to increase sales by almost 30%. And banks that have initiated this transition are already seeing an up to 65% increase in cross sales and 30% net annual growth in their primary customers. If you want the source references, they're all in the white paper. But just on the point of the democratization of financial advice, we had a recent webinar, some of you may have attended, with Nicola Breyer. And a webinar was on open finance. It was kicking off our next quarter's white paper on open banking and open finance. And she made the point that we are finally at the cusp of having proper financial planning and advice at our hands for mass customers and the mass market, which was, for cost reasons, only ever historically delivered to a few, which I'm sure resonates with everybody here. Now, I did want to have, just before I move off this one, an honorable mention. I haven't got it in here, and I haven't got it in the white paper either, and that is agentic employees. Last year at Cybos, I'd come back and I included in a blog that I'd wrote where Leanne Russell from BNY Mellon had said in a keynote that BNY employ over 100 employees, agentic employees, AI employees, that have all got their own email addresses, their own logins, their own Microsoft Teams accounts, and they join Microsoft Teams chats with humans as part of a team. So agentic employees is a rising phenomenon. I didn't put it in this this white paper. I think it's something that we're going to see a lot more of in the coming months, and not necessarily for human replacement, but just for capacity increase and human augmentation. It's a one to watch. Now, I'm going to get a wiggle on here. I'm going to talk just briefly about governance because there is, agentic AI does introduce new elements of risk, and the institutions that succeed in the agentic era are not only those that will deploy the most capable agents, they are those that deploy the most rigorously governed agents. And I've got to be a bit direct. The traditional compliance frameworks in banks are not fit for purpose in an agentic world. The traditional compliance frameworks were designed for deterministic systems that fail predictably, or they crash and they throw errors when they encounter a broken rule. Agentic AI, driven by probabilistic large language models, introduces completely new and dynamic failure modes that legacy governance just can't anticipate. So I want to quickly whip through 4 categories of unique risk that agentic systems introduce. The first one is cascading errors, because we had spoken about fraud. I had spoken about swarms a little while ago and multi-agent teams. And because agents can chain multiple actions together rapidly, a single hallucination or misinterpretation can propagate across interconnected systems in ways that are just impossible to anticipate or diagnose. The World Economic Forum even explicitly warns about the phenomenon. It's not hypothetical. It is a systemic risk that must be addressed architecturally through strict boundaries, right-protected environments, and irreversible action gates. Anecdotally, I am busy reading a pre-release copy of Chris Skinner's latest, what he calls financial fiction. It's a fictional book called The Day We Couldn't Pay, and it pretty much highlights this exact scenario. The next one is algorithmic collusion, and this one surprises a lot of people when they first encounter it. Research has shown that multi-agent systems can spontaneously develop hidden communication strategies to coordinate on pricing or market behavior, and they start pursuing shared goals without any explicit human interaction. Now, in a sector as heavily regulated as ours, the implications of undetected collusion and machine-generated collusion are severe. That is a risk I'm glad I am not having to cope with today. The third is prompt injection. This one is quite familiar to a lot of people. Malicious actors actively seeking to exploit your agents by feeding them compromised instructions. And De Nederlandsche has warned explicitly that generative shrinking banks' cyber response windows as the autonomous models can independently identify software weaknesses and generate sophisticated attack techniques at scale. The final one is vendor concentration risk. Now, the foundational models powering these agents are predominantly controlled by a very small handful of global technology firms. And the Digital Regulation Cooperation Forum warns that if agents become deeply embedded in operational workflows, institutions could find themselves irrevocably tied to a single provider's infrastructure, limiting interoperability and heightening systemic vulnerability. I would go one step further to say that we have had a recent live example of exactly that, where a foundational model of Anthropic's was pulled the Anthropic were forced to pull their foundational model by the US government, and a number of organizations had already started building on that. That makes me very worried. I have to admit that the vendor concentration risk doesn't only exist in agentic systems or in AI for that matter. And in our think tanks, there was a quite emotional discussion about sovereignty, because right now we don't really have the competing foundational models in Europe. It is a concern for a lot of people. I don't go too deep into that. I don't cover sovereignty in the white paper. I think that is a discussion in its own right. So, in the thing that I get really excited about is the rise of the agentic customer, which I regard as the most disruptive theme in the entire white paper, apart from fraud and risk. So we speak a lot, and a lot of people that I spoke to wanted to talk about the systems that they were building and that they were deploying. And when I asked, what happens when your customers deploy agents, a lot of them were saying, oh yes, yeah, but that's quite far off. I believe that the rise of the agentic customer is already underway. Consumers and corporates alike are already beginning to delegate complex, even time-consuming financial tasks like comparing insurance policies and evaluating mortgage options to intelligent agents acting on their behalf. And unlike human shoppers, these agents are completely immune to decision fatigue, choice overload, or marketing seduction. I moderated a panel at the European Payments Council last week. It was a panel on agentic commerce. And I started that just with a brief anecdote that I will share here, because I want to make this quite visual in people's minds when I talk about an agentic customer. And I wanted to explain to the people in the room my perception of what my future agent is going to be like. I'll tell the story. I was having lunch during a day of board meetings with a whole lot of bankers. This is going back a couple of decades ago now. And a board member at a bank spilled some gravy on his shirt, and he had to go back into the boardroom just after lunch. So he tried to clean it. He pulled out his mobile phone and he phoned his PA and he said, hey, I've just spilled some gravy on my shirt. I need a fresh shirt. Please, can you pop out and go and get one for me? And by the way, I completely forgot that it's my mother's birthday on Sunday. Could you later on today go and pick up something for her that she would like, and a birthday card for her, so we can send it off and get it to her by Sunday? And I kid you not, within about 20 minutes, the PA was standing next to him, held out a shopping bag with a fresh shirt. Now, back to that APM test at the beginning. Autonomous, proactive, and memory. So autonomous, the PA didn't have to be told exactly what shop, what size shirt, what color shirt. The PA had actually remembered what color suit he had had on that day and knew what color shirt would go with that. Autonomous, they had the autonomy to go out and go and buy whatever want, but within boundaries. They knew how much he normally spent on shirts. Memory, they knew his size, they knew his color preference, they knew his brand preference even, and they got a shirt that, he could have been the one walking to the store, he would have bought the same shirt. Now, a bit of proactively, at the same time as putting down the bag with the shirt, the PA turned round and said, I knew that you would forget your mother's birthday. So last week, I already bought a birthday present from you and a birthday card. The birthday card is sitting on your desk waiting for you to write in it, and then I'll get it sent off to your mother. Now, they also didn't have to ask where the mother was. But that demonstrated proactivity. So a future agent will display those things, but there's going to be a twist. My future agent won't be like a PA. I've never had a PA in my life. My future agent will be my digital twin. It will be me on the best day and the best focus that I could ever have. Excuse the cheesy photo, but what would a AI presentation be without a bit of AI image generation, right? I only took that photo 2 hours ago, and that is Google Gemini's rendition of me as me and my digital twin. But the point is that even Peter van Heers, again going back to our event in Amsterdam, he said that even that the business to consumer model is rapidly evolving to a business to agent model where customers will gladly delegate their tasks to an autonomous agent. And I think that the implication of that is quite profound, because much of retail banking revenue has relied on a degree of behavioral inertia. They have trusted that consumers do not switch for better interest rates or anything like that, just mainly out of either confusion or just they can't be bothered. But my digital twin isn't ever going to get tired. It is going to have the ability to analyze the market conditions. It's going to be singly goal orientated, maximize Andrew's financial health. And it's going to do that relentlessly. It's going to rebalance savings. It's going to switch accounts. It's going to be a massive change for the banking industry, and it comes with a couple of fairly thorny issues, because if my digital twin agent starts opening accounts, logging in, making payments, and acting autonomously on my behalf, the only issue of liability. Who is liable, me or my agent? Is my agent me? Is the identity stack and the traditional fraud prevention stack going to be able to cope? We've got a new frontier, what's known as Know Your Agent protocols, verification frameworks for non-human actors that establish not just their identity, but the mandate of the agent as well. What is the agent authorized to do, on whose behalf, and within what spending limits, and who bears the liability when something goes wrong? Now, I'm going to spend a last couple of minutes, so I can still stop in time and have some time for questions, maybe. I just want to give you a quick 4 scenario, taking a lead out of typical consultants. Who doesn't like a 2x2 grid? Just to give you an idea of scenarios that emerged out of our research for 2030. Kind of strategic scenarios on the way that the banking landscape could evolve. So the first one is agent augmented banking, where agents act as powerful digital colleagues. This is pretty much where we are at the moment. They support human employees. Banks remain the central customer interface, and institutions compete by offering superior hyper-personalized advisory services, and they use AI to liberate their staff from all the admin. But the human-in-the-loop structure is very strictly maintained. Scenario 2, agent-mediated banking. This is where the agents sit outside the bank. Third-party agents provided by maybe major technology firms or fintech aggregators, they become the primary interface between customers and banks. Banks are forced to accept that they're going to end up competing strictly on price, speed, reliability. Institutional brands might even fade, and banks may effectively become pure product manufacturers. Scenario 3, or fully autonomous ecosystems. Agents that my agent negotiates with your agent. They transact, optimize financial decisions, virtually no human involvement. Dom S. Mystery gave a great 10-year-old video actually in Brussels during his keynote that displayed that kind of a thinking. It was very forward thinking at the time, and actually is still quite forward thinking right now. In this environment, the agents move cash around across borders, across platforms in real time, and banks have to ensure their product offerings are entirely API driven and machine readable. And then we come to the fourth scenario, which is trusted relationship banking, which, despite the widespread available of autonomous AI, customers may still continue to place a premium on human expertise and institutional trust. So routine tasks may be fully automated, but customers still actively seek out human advisors, particularly around the high-stake events. Like Jonathan from Belfius had said during our Brussels event, managing a customer's emotions and preventing panic during market volatility will remain a uniquely human capability that AI genuinely cannot replicate. Now, the most likely outcome is that all four scenarios will coexist across different customer segments, maybe even across different financial institutions. At one of our recent roundtables, the person I was sitting next to, shall remain unnamed because it was a Chatham House rule, had confided in me that this is one of the big bets. Although they are placing bets across the board, they firmly believe that this is the unique place that banks can maintain their relevance in the future, and they are doubling down hard on the trusted relationship scenario going forward. So agentic AI is unlikely just to improve your existing banking processes all by itself, but it will fundamentally alter how financial products are distributed and how customer relationships are formed. And it will fundamentally transform which organizations capture the value. So I am going to leave you with one key question, and it's the one that I end the white paper on, actually. Which one of those futures that I have described today will you start building towards tomorrow, or are you building towards today?